Welcome to Griffonomics. Today, Thomson Reuters, trading under the ticker TRI. Thomson Reuters is executing a dominant product expansion playbook, embedding its proprietary co-counsel legal assistant layer deeply into sovereign accounting and law systems to capitalize on high-margin advisory transitions. However, this technology compounding thesis is currently navigating a sharp optical valuation premium, trading at peak historical multiples while battling a structural 5% secular contraction across its legacy print divisions. Okay, so let's just take a collective breath and try to translate that extremely dense Wall Street speak into, actual plain English.
Yeah, please do, because that is quite the mouthful to kick things off.
Right. Basically what it means is Thomson Reuters is making an absolute fortune selling specialized AI to lawyers and accountants. And because of that massive success, their stock is incredibly expensive right now.
Right.
But, and here's the catch, beneath all that shiny new technology, they're still dragging around this dying legacy business. They print physical textbooks, and that side of the house is shrinking by like 5% every single year.
Yeah, that is a much more digestible way to look at it, I think.
Yeah.
And it really sets up the whole fascinating tension we're exploring today.
Exactly. So to figure out what's really happening under the hood here, we are doing a deep dive into a huge stack of recent sources. We've got their Q1 2026 earnings transcripts, internal financial reports, and some really sharp strategic analyses.
There's a lot of material.
There really is. And our mission for you today, whether you're an investor, someone watching the tech space, or just curious about where the future of work is heading, our mission is to unpack exactly how a 150-year-old data giant is just weaponizing AI to build this impenetrable economic moat.
It really is honestly a masterclass in corporate adaptation. I mean, it flips the whole standard disruption narrative completely on its head.
Which is the central irony of this whole deep dive, right? Like everyone just assumes AI is going to come in like a tidal wave and wash away all these old legacy white-collar institutions.
Exactly, the whole replacement theory.
Right, but the sources reveal how this specific institution, Thomson Reuters, is actually using AI to make itself even more indispensable.
They're digging in.
Yeah. But before we can even begin to understand the financial explosion they're experiencing, I think we really need to understand the fundamental operational divide, the divide between their product and, the standard AI tools everyone else is using on the open internet.
Right, and that divide, it comes down to a really specific concept that Thomson Reuters management calls Fiduciary-Grade AI.
Okay, fiduciary grade. Break that down for us.
Well, think about their core user base for a second. We aren't talking about college students writing essays. We are talking about global corporate law firms handling multi-billion-dollar mergers, top-tier tax professionals, massive audit teams.
The heavy hitters.
Exactly.
Yeah.
These are people who operate with literally zero margin for error.
Right. Let's just bring that down to earth for a second. Think about the anxiety you feel when you file your own standard income taxes every year.
Oh, absolutely terrifying.
Just hoping you didn't miss, like, a W-2 or a random form. Now multiply that anxiety by 10,000. If a standard tech worker makes a mistake, maybe a line of code breaks, right? Or an app crashes for an hour.
Sure, people get annoyed, but they move on.
Exactly. But if a corporate lawyer or a multinational auditor makes a mistake, the consequences are astronomical.
Yeah, you're talking about devastating regulatory fines, you're talking massive malpractice lawsuits, and entirely ruined corporate reputations. So these professionals, they require outputs that are deterministic.
Deterministic.
Yes, and grounded in extremely precise citations. They absolutely cannot rely on Silicon Valley's standard probabilistic foundation models.
Okay, I want to pause on those words because I think they are critical to the whole thesis. Explain the difference between probabilistic and deterministic for, someone who isn't building neural networks all day.
Gladly. So when you use a standard general-purpose chatbot out there on the web, it is probabilistic. It's essentially just highly educated autocomplete.
Like when your phone guesses the next word in your text message.
Basically, yeah. It guesses the next most likely word in a sentence based on the massive, completely unverified slurry of data it scraped from the internet.
Right.
And most of the time, it sounds very confident and correct. But sometimes, it guesses wrong. And in the AI industry, this brings us to the high-stakes hallucination problem.
Oh, the hallucinations. I mean, the stories about this over the last few years have been wild.
They really have. Over the past few years, we've seen these highly publicized real-world incidents. You had lawyers at global firms trying to cut corners.
Right, trying to save some billable hours.
Exactly. They used generic open web chatbots to write legal briefs. And the chatbot, just doing what probabilistic models do, simply invented fake legal precedents.
It just made them up.
Literally hallucinated entire court cases that never even existed, complete with fake docket numbers in quotes.
I mean, just picture that for a second. A lawyer stands up in federal court, cites a case to a federal judge, and the judge has to look down and say, "Counselor, this case literally doesn't exist."
It is a career-ending moment.
Totally. And you know what the ultimate irony in those stories is? It's how those lawyers actually got caught.
Right. The opposing counsel in those exact cases actually used Thomson Reuters verified tools, like Westlaw Advantage, to check the citations. They caught the errors and basically exposed the hallucinating lawyers right in front of the judge.
Which is just, it's essentially a free global advertisement for why fiduciaries have to pay for verified tools.
It's the best marketing they could have possibly asked for.
Okay, so how does Thomson Reuters actually solve that hallucination problem from a structural standpoint, like technologically?
They solve it through a structural data fortress. So first, they offer ironclad, entirely proprietary data privacy and protection protocols. They guarantee their corporate clients that zero input data, absolutely none of the highly confidential merger docs or tax records they feed into the system will ever be recycled into public AI output.
Wow, okay, so it's a closed loop.
A completely closed loop. And it's a privacy promise that standalone tech startups simply cannot mimic. Because those startups, they desperately need user data to train their underlying models to get better.
Okay, I get that data privacy is critical, but I have to play devil's advocate for a second here.
Go for it.
Because compute power is basically a commodity now, right? If I'm a massively funded Silicon Valley startup and I've got, say, billions of dollars from venture capitalists, why can't I just build a better bot? Why can't I just scrape the internet for legal documents and build a competitor?
It's a great question. And honestly, it's the exact question tech investors constantly ask.
Yeah.
But it fundamentally misunderstands what Thomson Reuters actually owns.
Oh, bro.
You can't just scrape the public internet for this stuff because the public internet is full of unverified, contradictory, outdated, and frankly, false information.
Just a giant mess of data.
Right. Thomson Reuters doesn't use the public internet. They have century-deep vaults of verified data.
Yeah.
We're talking about 1.9 billion highly curated proprietary documents.
1.9 billion. Let that number sink in for a minute. These are verified documents that aren't just sitting on a public Wikipedia page somewhere.
Exactly. And it's not even just the static data that matters. The real secret sauce is the human element. They employ roughly 2,600 human subject matter experts.
Wait, 2,600?
Yeah. Seasoned attorneys, tax analysts, data scientists, and they actively train the AI. They've built this thing called the co-counsel bench.
The co-counsel bench, okay.
So before an AI's reasoning is ever allowed to reach a user, these human experts test it, they validate it step by step, and they correct its logic. A tech startup in Silicon Valley doesn't have 2,600 elite legal and tax experts just sitting around checking the algorithm's homework.
Right, they just have engineers. Okay, so the verified data vault is the ultimate moat. I get that now. But that raises an entirely new operational problem.
Which is?
Building the underlying AI foundation models, the massive engines that actually do the raw thinking, costs billions of dollars in research and development. Just look at what OpenAI or Google spend.
Oh, the compute costs are staggering.
Right. So how does a company like Thomson Reuters, which isn't a hyperscaler, deploy this technology without bankrupting themselves building a model from scratch?
Well, this is where their strategy is just so elegant. They don't build the foundation model.
You don't build it at all.
Nope. On May 12, 2026, they announced this landmark expansion of their partnership with Anthropic, which is the company behind the highly advanced Claude AI model.
Okay, so they're renting the engine, essentially. Let's look at the technical mechanics of that.
Exactly. They're renting the compute brain. They are completely rebuilding the next generation of their co-counsel legal assistant on the Claude Agent SDK. But the real magic is in how they connect Claude to their 1.9 billion documents.
How do they do it?
They use something called a Model Context Protocol, or MCP.
MCP. Again, let's unpack that. What does that protocol actually do, like in plain English?
Think of the MCP as this highly secure technological bridge with a very strict bouncer at the door. It plugs Claude's advanced reasoning engine directly into Thomson Reuters' proprietary data vaults.
Okay.
But here's the key. It restricts Claude. Instead of Claude guessing answers based on its general knowledge of the open web, the MCP forces Claude to anchor its output strictly in historically deep, verified legal records from the vault.
Wow. So it creates a truly intelligent workflow engine. The lawyer just types a request in plain language and the engine takes over.
Precisely. Because it's an agentic system, it autonomously plans out the task. It figures out what specialized tools it needs, goes into the vault, retrieves authoritative content mid-process, and then continues drafting.
Mid-process, wow.
Yeah, it can draft documents with perfectly accurate citations and seamlessly toggle between general, brainstorming exploration and hard, citation-grounded legal work.
I absolutely love this strategy. Let's try to put this into a visual analogy. It's
Right.
like TRI is letting big tech spend billions of dollars to build this ultra-fast Formula One race car.
Right, and TRI owns the only paved road that the car is allowed to drive on for corporate clients.
Exactly. And they own the toll booth. Every time that shiny new F1 car wants to do actual high-stakes legal work, it has to pay the toll to drive on TRI's verified road.
It's brilliant positioning.
By integrating their fiduciary-grade libraries directly into general-purpose workflows, Thomson Reuters basically ensures that wherever a lawyer or accountant chooses to work, they have to pass through that specialized TRI data toll booth. They lock the company into the absolute center of how professional work gets done.
And that positioning is incredibly powerful. But of course, a great technological story is really only a story until it actually shows up in the numbers.
Very true. So let's look at the actual scorecard here. Does this technical advantage actually translate into unmatched pricing power and top-line growth?
The short answer from the sources is a resounding yes. The recent corporate outperformance is incredibly robust. In the first quarter of 2026, Thomson Reuters printed an 8% organic revenue growth overall.
Which, just for context for everyone listening, is massive. Usually, a legacy data company is thrilled to just grow at the rate of global GDP, maybe 2 or 3%. 8% means something fundamental has completely shifted.
Oh, absolutely.
Yeah.
And it gets even more dramatic if we look closer. Management breaks their core business down into the big three segments. That's legal professionals, corporates, and tax and accounting.
Okay, the big three.
Those big three delivered an outstanding 9% organic revenue growth, generating a combined $1.77 billion in just one single quarter.
Almost $1.8 billion in 3 months, just from those three segments.
Exactly. And if we dig even deeper, we can isolate a massive acceleration inside the legal professionals division itself. Now, their federal government business was a little bit soft. It only grew 1%, mostly due to some short-term spending delays.
Federal budgets are always slow.
Right. But if you exclude that slower government component, the commercial legal division saw a massive 11% organic expansion.
11% organic growth for a legacy business unit. I mean, as an investor looking at this, my immediate thought is that has to be a short-term sugar rush, right? Like, is that sustainable, or is it just early AI adopters rushing in to try the shiny new toy?
That is the multi-billion-dollar question that analysts are aggressively debating right now. But the sources suggest it actually is sustainable, primarily because of the sticky, non-discretionary nature of the product.
Sticky meaning hard to leave.
Yes. Remember, this isn't just an app on someone's phone that you can delete. Once a major law firm integrates an agentic AI like CoCounsel into its daily workflow, once it literally becomes the backbone of how they draft contracts and do legal discovery,
Right.
pulling it out becomes operational suicide.
You'd have to retrain everyone.
Exactly. The AI becomes a critical piece of their infrastructure.
Yeah.
So they will accept premium price hikes because the alternative is ripping up their entire firm's workflow and falling behind competitors.
Okay, I buy the top line growth. They definitely have pricing power. But here's what doesn't make sense to me.
Let's hear it.
Running AI is notoriously expensive. I mean, compute costs are absolutely bankrupting some tech startups right now. Deploying heavy AI technology usually compresses margins. So how is TRI deploying all this heavy tech without absolutely crushing their profit margins? We really need to map the underlying unit economics here.
This is where their operating efficiency genuinely surprised the market. In that same Q1 2026 period, their profitability didn't shrink. It actually expanded.
Wait, expanded?
Yeah. Adjusted EBITDA accelerated 9% to $881 million.
Wow. And what does that look like as an overall percentage margin?
They hit an elite total company margin of 42.2%. And the true engine of the company, those big three divisions, operated at an even higher 46.7% adjusted EBITDA margin.
46.7. So Mechanically, how are they pulling that off when every single time Claude runs a massive query, it costs money in API compute fees?
It really comes down to two things. First, automated software scaling on the customer side. And second, incredibly aggressive internal cost compression on their own operational side. They have this massive internal initiative called Reimagine How We Work.
Catchy title.
Right. But it means they aren't just selling AI, they are actively using it internally to automate operations across their newsrooms, their editorial processing, and just general corporate overhead.
Give me a concrete example of what that looks like behind the scenes.
Sure. Imagine an international tax code changes overnight. Historically, Thomson Reuters might have needed, say, a team of 10 human analysts working for 3 days to cross-reference the new code against existing global treaties, draft the updates, and publish it to their platform.
A lot of man-hours.
A ton. But now, an internal AI agent can do that first massive cross-referencing pass in about 3 seconds.
3 seconds versus 3 days.
Exactly. The human experts just verify the final output. So between those massive internal savings and the premium pricing power they hold over their customers, they're successfully expanding corporate profitability by an expected 100 basis points year over year.
Okay, just to decode that for a second. 100 basis points is an extra 1% of pure margins squeezed out of their operations. For a company doing billions in revenue, an extra 1% translates to tens of millions of dollars dropping straight to the bottom line.
It's massive.
It's like a digital printing press. Once the AI infrastructure is built, the marginal cost of onboarding the next global law firm basically drops to near zero. All that premium pricing just becomes pure profit.
Exactly. The foundational multi-billion-dollar R&D costs are largely borne by partners like Anthropic and Google. TRI just pays for the compute and the API calls as they go, while charging a massive premium for access to that verified data layer.
And elite margins naturally generate massive cash flows. So the next logical question is, what exactly is their playbook for spending it all? Let's try to reconcile the immense cash-generating architecture of their capital allocation blueprint.
Well, they're throwing off so much cash that they are returning a massive amount of it directly to shareholders. Their adjusted earnings per share climbed 10% to $1.23 for the quarter.
Nice jump.
And that was supported by a 19% explosion in quarterly free cash flow, hitting $332 million.
I mean, that's just a staggering amount of free cash to, just have sitting around.
Oh, it gets bigger. The sources document their massive capital runway. We are talking about verifying an estimated $9 billion of capital capacity available through 2028.
But really, $9 billion in capital capacity?
Yep.
In a macroeconomic environment where money isn't cheap anymore, that is a massive competitive weapon. But what are they actually doing with it?
A huge chunk of it is going to shareholder repatriation. In the first quarter alone, they completed $262 million in share repurchases. And alongside that, they just completed a $605 million capital return framework.
So they're just buying up their own stock.
Right. By buying back their own stock, they effectively reduced their total outstanding share count by roughly 2%. They're continually optimizing that outstanding equity float.
All right, I have to push back here on behalf of anyone looking at these numbers, because if they have a $9 billion war chest, why on earth are they spending hundreds of millions buying back their own stock at peak, historically high multiples? Shouldn't they be plowing every single cent into R&D or acquiring more AI startups to defend their moat?
It's a very fair critique, and it's one a lot of observers have. It raises an important question about their strategic positioning, but you have to remember what we discussed earlier. They don't need to spend billions on baseline AI compute R&D because they are fundamentally model agnostic.
Right, they aren't building Claude.
They are perfectly happy letting Anthropic, OpenAI, and Google fight that incredibly expensive, bloody war. TRI's R&D is focused purely on the application layer and maintaining the human experts for their data vaults, which is far, far less capital intensive.
So they don't need the billions for server farms.
Exactly. And as for acquisitions, they are definitely still hunting for early-stage vertical AI assets globally. But they generate so much cash that it isn't an either-or scenario.
They can do both?
Yeah. They can afford to buy specialized startups to plug into their ecosystem and return massive capital to shareholders to keep their equity tight and their stock price supported.
Okay, we've thoroughly established the bull case for this data monopoly. They have the data, they have the margins, and they absolutely have the cash. But I think it's time to synthesize the final investment case and lay out the technical execution risks that are lurking beneath the surface. No company is bulletproof. Let's start with the final verdict on their valuation.
The final verdict from the sources is that an enterprise trading at peak premium multiples still represents an elite value safe haven for defensive asset allocators.
Oh, safe haven.
Yes. Even if the broader market gets choppy, they are shielded because of the sheer predictability and defensibility of their subscription cash flows.
Right. Coming back to our analogy from earlier, Thomson Reuters functions as an unassailable data governance toll road connecting human professionals to autonomous digital workflows. As long as professionals need verified data to avoid malpractice, they literally have no choice but to pay the toll.
Exactly. But, as you said, it is not without risks. The sources explicitly note 4 primary execution risks that anyone tracking this space has to keep an eye on.
Let's hear them. Lay them out.
First, going all the way back to the intro, they are still battling a persistent 5% secular decay across their legacy print revenue lines. Physical legal textbooks and corporate statute manifestos are in terminal decline, and that acts as a continuous top-line drag on the overall business.
Makes total sense. Nobody is lugging around 30 pounds of heavy law books if they have co-counsel autonomously drafting briefs on their iPad. What's the second risk?
Second, there are those short-term spending delays inside their lower-growth federal government business segments. We saw that drag down the overall legal segment growth to just 1% this quarter.
Yeah, you mentioned that.
Government budgets are notoriously slow to adapt to new tech, and navigating federal procurement cycles is always a massive headache.
Very true. Okay, what's risk number 3?
Potential execution friction as they attempt to transition complex international tax codes into autonomous advisory suites.
Why is that specifically a friction point? It seems like it would just be another data set.
Because international tax codes are highly sovereign and deeply intricate. You are dealing with different languages, conflicting global trade treaties, and really localized nuances. Automating that across global borders without letting a single hallucination slip through is incredibly difficult from an engineering perspective.
Right, and if they get it wrong, a multinational corporation pays the wrong tax to a foreign government, which is a total disaster. What is the fourth and final risk?
High-stakes acquisition integration risks.
Meaning what, exactly?
As they deploy billions from that $9 billion war chest to buy early-stage vertical AI assets across the globe, they have to seamlessly integrate those startups into their existing, highly rigid fiduciary architecture.
Oh, I see. Because if they bolt on a flashy new startup and that startup's tech accidentally hallucinates a fake case in a real courtroom, the entire fiduciary-grade brand promise is totally compromised.
Precisely. The moat is only as strong as its weakest data point.
Man, this has been such a fascinating look at how a legacy data company is navigating the AI revolution, not by fighting it, but by monetizing the guardrails.
It's a completely different playbook.
It really is. But before we wrap up, I want to leave you, the listener, with a final, slightly provocative thought to just mull over on your own. We've talked endlessly today about how this AI makes firms massively more efficient. But think about the broader implications for the white-collar workforce.
Oh, the human element.
Yeah. If agentic AI eventually automates the thousands of hours historically billed by junior paralegals and first-year accountants, does the total headcount at these massive firms eventually shrink? And if it does shrink, what happens to Thomson Reuters' per-seat subscription pricing model in a world that suddenly needs half as many human fiduciaries?
That is the long-term question.
It's a paradox of efficiency that the entire industry will eventually have to face. Thank you for joining us on this deep dive.